Hello, everyone. If your business deals with international transactions, you know that Forex rates can be a real roller coaster, right? They can seriously impact your bottom line. But the big question is, how do you actually treat those gains and losses for tax purposes, especially under the new Income Tax Act of 2025? Well, getting this wrong can be pretty costly. So in this explainer, we're going to break down the crucial rules you absolutely need to know. So, here's our game plan. We'll kick things off with a practical scenario that I'm sure many of you have faced. Then we'll get into the weeds of the general rule, which is Section 43, and its really important counterpart, the exception in Section 42. We'll put them side by side to make it all crystal clear, and then wrap up with some key compliance points and a quick summary so you walk away fully prepared. All right, let's jump right in with a situation that pops up all the time for business owners and accountants. So, let's imagine this. You import some goods for your business, and at the time, the exchange rate is indeed 80 rupees to the dollar. But life happens, and by the time you actually pay that invoice a month later, the rate has jumped to 82. You've ended up paying more than you planned for. So, the big question becomes, is that extra 2 rupees per dollar a tax-deductible business loss? Well, like with a lot of things in tax law, the answer is, it depends. To find our answer, the first place we have to look is Section 43 of the Income Tax Act 2025. You can think of this as the main road, the default rule for pretty much all Forex fluctuations. So the starting point here is Section 43, and its approach is refreshingly simple. It basically says if you gain money because the exchange rate moved in your favor, well, that's treated as business income. And on the flip side, if you lose money, it's considered a business loss. It's a straight line to your profit and loss account for that year. And if you look at the actual text of the law, you can see it right there. It says any gain or loss shall be treated as income or loss, plain and simple. But, and this is a huge but, look at those first few words, subject to the provisions of Section 42. That's a massive clue. It's the law telling us, hey, there's an exception coming, so pay attention. Now, for those of you who've been navigating the tax world for a while, this idea probably feels familiar. And you're right. Section 43 of the 2025 Act is essentially carrying the torch from Section 43AA of the old 1961 Act. So there's a good bit of continuity here, which is always nice to see. And that brings us to the crucial exception that Section 43 hinted at. This is Section 42. And folks, this is where things get interesting. And it's also where a lot of mistakes can happen. So let's break it down. So you might think Section 43 is the whole story, but it's not. When your Forex gain or loss isn't tied to everyday stuff like inventory, but instead it's linked to buying a major long-term asset, what the law calls a capital asset, the rulebook changes entirely. And this is the heart of the exception. Instead of claiming a Forex loss as an expense in the current year's P&L, Section 42 says, nope, you're going to add that loss to the original cost of the asset on your balance sheet. We call this capitalization, and it's a big deal because it affects your depreciation claims and capital gains calculations way down the road. Now, you can't just apply Section 42 whenever you feel like it. You have to tick all of these boxes. The fluctuation has to change your liability. It happens when you actually pay. It has to be for a business asset. And, this is a key one, the asset has to be imported from outside India. It's a very specific set of criteria. Okay. So we have the rule and we have the exception. Let's put them side by side so we can really see the difference and figure out which path to take. This chart really lays it all out. Here's a simple way to think about it. Section 43 is all about the now. It's a revenue treatment, hitting your income statement for the current year. Think about payments for imported raw materials or services. Section 42, on the other hand, is about the future. It's a capital treatment that changes your balance sheet. By adjusting the asset's cost, you're playing the long game, affecting future depreciation and the capital gains when you finally sell it. So here is your mental flow chart. Every single time you have a Forex gain or loss, you just need to ask one simple question. Was this transaction for buying a capital asset from outside India? If the answer is yes, boom, you're on the Section 42 path. You adjust the asset's cost. If the answer is no, you stick with the default road, Section 43. That's the fork in the road right there. All right, knowing the law is one thing, but applying it correctly without tripping up is the real goal. So let's talk about some key practical points to keep you on the straight and narrow. Okay, listen up, because this one is non-negotiable. The law is very clear that you must calculate these Forex gains and losses according to the Income Computation and Disclosure Standards, or ICDS. These are not the same as your regular accounting standards. They're the specific rulebook for tax purposes. Making sure your math lines up with ICDS is absolutely mandatory. And here it is, the most common mistake we see out in the wild: misclassification. For example, a business has a Forex loss on a big shipment of imported raw materials, and they incorrectly add that loss to the cost of their factory building under Section 42. That is a big no-no. Raw materials are a revenue item, not a capital asset. That loss should have been claimed as a business expense under Section 43. It seems like a small error, but it can lead to incorrect filings and, yes, potential penalties. Phew, we've covered a lot of ground, so let's just boil it all down and recap the most important points you need to take away from this. Just remember these 4 things. 1. The default is always revenue treatment under Section 43. 2. The big exception is capital treatment for imported assets under Section 42. 3. The deciding factor is always that one question: is it an imported capital asset? And 4. Do your math according to ICDS. Always. At the end of the day, every single foreign currency transaction leads you to this fork in the road. Does this gain or loss belong on your profit and loss statement right now, or does it change the value of an asset on your balance sheet for years to come? Getting that one decision right is truly the first and most critical step to handling your Forex taxation with total confidence. Thank you so much for joining me for this explainer. I really hope this breakdown of Section 43 and 42 was useful for you. If it was, please do consider sharing it with any colleagues who might also find it helpful. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.